I have a family member who's involved in heating and air conditioning. I say, when is business good for you? He says, when people are miserable, right? Well, I can say that's how it works on Wall Street. Wall Street makes money on the transition of money from people who are responding in fear to people who are responding with a plan and strategy. Hey folks, Colin Richards here. And once again, I'm excited to be with you on this episode of the Morgan Richards Show. And in this third segment on a series on market volatility, I'm going to be talking about the real problem when it comes to market volatility. In our last two segments, we talked about why markets sell off, the reasons people try to come up with for why they sell off, trying to be predictive, trying to get ahead of it. And the truth is nobody really knows. Right? You can throw out a lot of reasons, but only hindsight is going to reveal the true reason why a market sold off. And usually that's with a good amount of time. And unfortunately, we can't invest in hindsight. And then secondly, we talked a little bit about kind of the main issue of why market sell-offs, why market fluctuations, why market slides should be regarded as completely normal. Folks, if you invest for 10 years, 3 or 4 of those years are going to be bad years. They're going to end down. Right? And we learned that 2/3 of the time, your money is 2/3 of the years that the markets have had over the last 100 years have been sell-offs of 10% or more. That's a lot. 94% of the time, 5% or more years with market sell-offs. So you got to get used to the volatility. It's normal. And as Warren Buffett said, if you can't hold a stock for 10 years, you shouldn't own it for 10 minutes. But once we get past that, I just want to kind of underline what I've been saying behind the scenes about this. The underlying problem is fear. And in this segment, I want to help you understand why it makes no sense to succumb to fear, but rather to develop a strategy for financial independence where we deal with these problems in advance. All right, how to adopt the right mindset and behavior during market declines. The question I often get is, well, Colin, what are you doing about it? So when you design our portfolio and our plan for financial independence, are you going to get in there and be like selling off when the market's fluctuating? And the answer is, no, I'm not going to be doing that. The right question is not, what should we do about it? That is the wrong question. The right question is whether we should be doing something about it. Because if we've done this right, we've set your portfolio up in advance in what we at Morgan Richards borrowed from Morgan Housel, famous book, Psychology of Money. The real strategy of those who get ahead is what we call a barbell, where on one side, you've got your safe, secure investments that produce income, preferably on a guaranteed platform, so that your lifestyle is secure. You never have to go back to work nor worry about it. On the other side of that barbell are your at-risk investments, which are free to grow and build in the market without the burden of you taking monthly income off of them. And those investments are going to fluctuate, and we need to accept that. And if we can't accept the fluctuation, if we're always asking, well, what are you doing about it? Then we need to remove that piece of the strategy. We need to take that weight off of that barbell, and we just need to put on both sides all safety. Right? And you can do that. We can certainly respond to that. But here's what's happening is you're succumbing to fear. Listen to Dan Gardner in his book, The Science of Fear. Fear sells. Fear makes money. The countless companies and consultants in the business of protecting the fearful from whatever they may fear know it only too well. The more fear, the better the sales. I have a family member who's involved in heating and air conditioning. I say, when is business good for you? He says, when people are miserable, right? When stuff is breaking, when the air conditioning goes out or the heat goes out and people are miserable, business is good. Well, I can say that's how it works on Wall Street. Wall Street makes money on the transition of money from people who are responding in fear to people who are responding with a plan and strategy. I want you to be a part of that latter group. Let me give you an example, totally out of the financial industry. January 5th, 2024, a door plug flew off of an Alaska Airlines plate mid-flight. Talk about scary stuff. Scary stuff, right? We would think, holy cow, nobody is ever going to fly again. Well, wait a minute. 0 people died that day of airplane crashes, but would you like to know how many died of other causes? 120 Americans died that day from vehicle crashes. Are you still driving? Or have you succumbed to fear and now you're using your horse and buggy or walking? 136 died that day from opioids. 230 died of COVID-19. Yet I don't see a lot of masks out. Morgan Housel, in addition to his barbell strategy, has a lot to offer in his book, The Psychology of Money, to help us through this problem of fear. Here's what he says. Every past decline, the hindsight view, looks like an opportunity. Every future decline looks like a risk. Isn't that the truth? If we can get out of that mentality, I want us to succeed and prosper. Having stocks in your portfolio long-term are going to help you. They really are going to help you. And as Robert C. Wright, CIO, Chief Investment Officer of Madison Avenue Securities, recently said in an article, if you don't want to invest in equities because you fear a market crash, then you shouldn't be in equities. But let's consider this before you exit the equities market. If you look at the one-year range, long-term perspective of stock returns, what's the possibilities? Minus 37% to plus 52%. That's kind of your, they talk about various mathematical formulas, right? When you're defining the qualities of an investment. And one of those is the range from possible downside to possible upside. That's a huge difference, right? That's 89% from minus 37 to 52%. If you're asking your financial advisor or Lord & Richards or yourself to avoid all market volatility whatsoever, that's what you're up against in the short term. That's why I tell my clients, we're really not going to be evaluated by short-term performance because those swings that the market gives are too great. Now, we can help you manage that with an institutional risk management strategy. But look what happens when we just shift our focus to a 5-year. If we're going to evaluate things on 5-year performance, stocks range is minus 2 to 29%. That is far less volatility. And could you put up with the possibility that you'd be minus 2 after 5 years? If you can't, again, you shouldn't be in equities. Or how about 10 years? Minus 1 to 20%. Yep, we've had markets that were down after a 10-year period. If you can't handle that, you got to recognize, okay, I'm not going to be in that game. And then 20-year, the range is 6 to 18. Most of my clients who are about to retire can expect 20, 25, 30 years in retirement. And if we have that kind of long-term view, then we're going to be successful. But if we have the 1 or 5-year view, we're not. Here's another great quote by Robert C. Wright. In the near term, markets act like a voting machine, subject to the emotions, the whims, and the headlines of the moment. Over long periods, they are like a weighing machine, separating reality from fantasy, and ultimately reality wins. I can't wait to talk to you about this and help you develop a plan to become financially independent.